Hey everyone, it's Bo Benjamin here with Bo Benjamin Realty Group powered by eXp, and today's video is the 2022 end of year market report as well as the 23 market update projection. So let's jump straight into it here. I'm going to just give a brief summary and then we'll dive into some reports here and we'll make this quick today. So first of all, the sky is not falling. I can't tell you how many people every day I speak to are worried about the market. How's the market doing? Oh, it's slowing down, right? Everything's, doom and gloom all the time. I'm here to tell you that it's just not true. I mean, statistically, I'm going to show you it's not true. Yes, the rates have risen, and that causes some buyers to either not be able to afford the house they want, or it has caused pause for some buyers. Some buyers being the key. There were a lot of buyers and there still are. So the market is still in a seller's market, and I'm going to show you that. And everything is going to be projected to get back, probably not back to pandemic sort of situation, but back on the rise and in a good spot for everybody. So let's jump straight in here. Here is what we're seeing, pending home sales index. You see the red average line? And this is the pending home sales. So the higher this goes, the more homes that are pending. The lower it goes, the lesser sales that are pending and going to close. As you see, the line here, start of 19 was about right here. And as of January of this year, when the rates started going up, we started seeing a sinking below 2019 levels. So what does that mean? That just confirms people's gut feelings and suspicions. There's less home sales happening. This is a national, you see in the bottom corner, national metric. I'm going to show you why that's not true in Indianapolis as much. And the key is that just because there are a few less sales doesn't mean the home prices are going to crash. So that's why we want to go in and take a look at more data. The next slide here, I'm just going to jump straight back into the slides. This is a 30-year mortgage rate from 1990 till now. What does this show us? The mortgage rate used to be 10%. There's news to a lot of people. A lot of people don't believe when I told them it used to be in the 17-18% in the 80s. They don't understand that this rate that we had, this 2 to 4% rate, this may never happen again, folks, in our lifetime. So a pandemic-induced rate, a pandemic scared that the market was going to go crash and go into depression and all this other stuff. It was an induced rate, and it's probably not coming back. It's just not, I mean, I wouldn't bet everything on it, but I'd bet a lot on it. It's not going to come around again. So you can't hold your breath and hope that those rates are going to come back. You got to get used to normal. Now this is also abnormal, as you can obviously see in the graph. We've never experienced this in 30 years, this quick of a rise in rates in the short amount of time that they've done it this year. So this is likely going to, water finds its level, it's going to go back to normal. Normal rates are between 6 and 7%. So we're actually in the normal range right now. However, everybody in America wants this to go back down. Our leadership does, government. I mean, we want this back in the 4 or 5 range. I can't say where it'll end up, but I do expect it to go back to a normal, or I say normal, this is the normal again, 6 to 7% right here. This is the normal. But I do expect it to go back down some going into later half of 23 and early 24. Let's flip on to the next slide. This is the 10-year treasury yields and the mortgage rates. This just shows that they're very correlative, right? You can see that. And the treasury yields, if you watch those, then you typically can see where the mortgage rate is going to go. Inventory of homes are rising from super tight condition. So if you look at this, inventory was going down, 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 down. In 2020, pandemic, you can see it was already low, and you can see the seasonality here. And when people sell, inventory is higher in the spring, summer, and then it goes down in the winter. But what happened in COVID? Boom, hit an even larger, lower point. And we're still so low. This is so important because this drives price. I mean, economics is supply and demand, folks. This is why everybody that has this gut feeling of we're going to hit 2008 again, look at this. Look at where inventory levels were during the last real estate crash / depression, market depression. That's because of bad lending practices. We could get, that's a whole nother video. But the point is, there's people that have been buying cash, huge down payments, 20% down, 30% down during this last couple of years. We're not in a place where everybody's going to come underwater and you're going to get inventory levels and foreclosures like we did last time. So this is the part I'm talking about right here. This is 2008 recession crash through 13, and this is where we're at now. Pandemic levels coming out of the pandemic and where we're at now. Super low inventory. We still have high demand for buyers, and now we have a slight think of it this way: 10%, 20%, some sliver off the top of the buyer demand has they've went to the sidelines because they can't afford the rates right now, or they don't want to pay the rates right now. But we still have such low inventory that the buyers that are left over, the 60, 70, 80% of the buyer pie that's left over, still doesn't have enough homes to pick from. We just don't have the market conditions to cause a drastic reduction of prices. Median income to buy a middle home. So this is one of the reasons why we have some buyers on the sideline right now. Just last year, the median was under 60,000, as you can see. Now, this is across the nation. This is a national statistic, but we're over $80,000 median income to buy a median size home in the U.S. So that's why some of the buyer pie has been taken away, which has reduced the stress of the market, but it certainly hasn't flipped it to where it's a buyer's market. It hasn't caused the inventory levels of homes available to sell. So you've just stripped off a percentage of the buyers off the top, and we still have the same seller's market that we had before, just not as high-strung and stressful. And here we got single-family housing starts. Here was the problem. About 50% of the builders went out of the market whenever they actually exited the market, bankruptcy, etc., or just shut down their business to avoid bankruptcy in 2008. And they slowly have come back, but they haven't been keeping up with demand. So we need this to go up. And now the builders have come back because they're worried about these rates and what it's going to do. So they're actually making things worse. We still don't have enough inventory, and the builders are slowing down. This is terrible for buyers trying to find a home that they want to move into. So this is keeping the market where it's at or making it worse, not making it to where housing prices are going to drop, not to where we're going to go into a buyer's market anytime soon. There's not going to be any crash. We need more builders, more inventory, and they pulled back in 22. So that's actually not a good thing. They're scared that the 7% rate is going to drop it dramatically and kick all the buyers out of the market, but that's just not true. Buyers have other reasons other than monetary that they want to buy homes. They have families, growing families, relocating, etc., etc. First-time home buyers are entering the market at a rapid pace. Millennials are the first generation that are bigger than the baby boomers. So the natural cycle of things is you would have people exiting home ownership, whether it's through death, through downsizing, going into an apartment, etc., and then those would turn over to the first-time home buyers, and it's a natural cycle. But when you have a bigger group, millennials, bigger than the baby boomers, first generation ever bigger than the baby boomers, when you have them entering the market, they need more houses. And here's on the other side, we're extending the age of the lifespan. The average person is living longer. So we need houses that aren't being given up in the natural cycle, and we have the largest population ever coming into home ownership. So it's just not a condition that's going to cause market effects to change anytime soon. It doesn't matter if you were around in 2008 and you say, oh, this feels just like it. I'm sorry, but stats don't lie. It's just not the same market. And unfortunately, that misinformation is causing a lot of people to sit on the sidelines, not buy, when this is actually a great time to buy, and I'll explain that in a few minutes. Here's some benefits of having a mortgage. So this is the percentage of your salary towards your mortgage, and 35% 2022, this is just example numbers, right? $350,000, 7% interest. This is a fixed rate mortgage, but your monthly salary will grow at roughly 5% a year. I don't know where that stat came from. This is from a NAR slide, National Association of Realtors, provided to me through Buffini and Company. Let's assume that's near what you might get at your work year-over-year wage increase, and this is going to be fixed. So you see that your mortgage payment never changes, but your monthly salary might go up, and it should go up over time, and so you have less and less of your monthly salary. This is why mortgages help build wealth. This is just one of the many reasons, but having a fixed payment is huge over time, even if it is at a little bit higher percentage. And again, 6 to 7% is normal. Next up, U.S. median home price. Look at what these were at these years. This is just incredible. So there's a famous quote that says, with real estate, you buy and wait. You don't wait to buy. When you wait to buy, this is what happens. Now it costs more for the median house. But if you buy and wait, you get the benefits of this. And these are projections based on this curve. So if things hold true, buy real estate and wait. Don't wait to buy. That's a mistake. Nationwide forecast. This is some good numbers. So 2019 unit sales, this is the baseline. Home price went up 5%. 2020 unit sales went up, home price went up. 2021 unit sales went up, home price went up dramatically. 2022, we don't expect as many homes to be sold overall, and again, this is a national number, not Indianapolis, but the home price is still going to go up. They forecast this to be still not as many homes sold, and I believe this is according to the 2019 baseline, 7% less than in 2019, but we still expect the prices to hold true. And finally, in 2024, we hope that the rates come down a little bit, which should spike some sales, and we still will continue. So never do you see the projection. And this is coming from Lawrence Yun, who is one of the top 5 economists in the world for real estate. And if you can look him up, again, Lawrence Yun, he is the economist for National Association of Realtors. And honestly, I've not heard anyone smarter than him speak on this subject. So I would advise look him up if you have any questions about any of this data. His team puts this together, and we're lucky to have him as a great leader. Here's some changes. So buyers, here's a reason I told you I would talk about why buying now is good. The first one, no panic buying. We're going out and we're seeing homes. We're seeing multiple homes. We're seeing homes for a second time, and we're thinking about it. We're doing numbers. We're running budgets, estimates. We're thinking about the pros and cons. It's a more relaxed environment to buy right now. So honestly, this is great. This is how home buying should be, not when you're going out in the morning at 10 a.m. and you have to decide within a few hours if you want to make an offer, and then you have to wait and see if you won against 30 other bidders. So this is great. So no panic buying. The second one is more choice. Again, you can go see 2, 3, 4, 5 homes and pick the one you like the best. There were stories, unfortunately, in 2020 and 2021 where people ended up buying a house because they felt they needed to and had to make a bid because it was the only one available at that time when they needed to buy, and they don't love the house they're in anymore. Well, that's sad. I mean, I feel bad for those people that got in that situation, and maybe they relocated and they needed to buy right away, and there's reasons people do this. There shouldn't be any regret in the situation, but they're still thinking like, I might move again here more frequently or sooner than I expected to because it's still not the perfect layout, the perfect house that I really want. So look at this. I mean, this again is from Buffini, supplied by Buffini, but more choice is crucial. You get to choose a home you like. You don't have to be panicked. And then here's the other thing. This is up to you and your financial advisors and how you want to run your budget. But if we believe the projections that rates will go down, then you can pick the home you want now, and you don't have to put it into a 30-year fixed mortgage. You can, if you project the rates to go down, you can get an ARM mortgage product, and 5-7 year ARM. That may put you into a lower payment now, and then whenever the rates do go down, if they do, I have no magic 8-ball here, then you could go get that 30-year fixed and refinance into that product then. So there's options here that you can do, and you can work with myself and people that I refer to, mortgage partners, loan officers, and you can come up with a strategy, And you can do it at a near normal pace versus what we've had to do in the past few years. So this is a great time to buy. Not only that, but you think about the scenario. If you buy now, you have the house you like, if we take the time and do everything right, and you have the option to refinance, put it into a different mortgage instrument down the road. Well, you can do that on your lunch break. That's no problem. I mean, you can work on refinancing, put it into a different mortgage instrument later at your own pace. You can breathe. You can do that slowly. Versus you wait, and if the rates do go down as we project, then now you're going back into a market where all these buyers that were also waiting on the sideline are pushing back into the market. And guess what? Now we have scenarios where we may be competing against 2 or 3 other buyers, maybe 10, 20 again. I hope not. But now you found your perfect house in a few years because you waited and you wanted the rates and the perfect house to combine. That's when you want to purchase. Well, now you're competing against other people, and you have to pay more for that house. You have to outbid someone perhaps to get that rate and the perfect house. Well, if you can afford it, and that's the big question, if you can afford it, buy the house now, use a different mortgage tool that can get your payment in line with what your budget needs to be. And then when that happens, you don't have to compete against other buyers. You already own the house. You just have to change up your mortgage instrument and your budget then. So that's the better way, in my opinion. Obviously, it's all up to you. Let's talk about it offline if you have any questions. That's what I'm here for. For sellers, this is huge. Again, this is supplied by Buffini, and this is a National Association of Realtors slide here as well. So what I want to talk to about this, we have so many sellers that are trying to price. This is just an example. This is probably a median home price across the nation example. So we have sellers coming on the market and say, well, my neighbor sold for $416. I got to price it for $416, and now their houses are sitting on the market, and this is really messing everybody up, honestly. So buyers are saying, well, that's too expensive. I see other people reducing their price, so I'm going to wait and not bid at this level. Sellers are trying to hold steadfast at this level and saying, I'm going to get what my neighbor got. And what everybody is missing the point is, in January, the price was $350. And if you can sell, if you can be a savvy seller, understand the dynamics that you're still making 40 grand in this example, and price your home adequately, I'm still seeing multiple bids happen. So if you priced your home at the right price, you may get multiple bids and push it up somewhere in here. But if you're holding steadfast as a seller, you're probably going to do price reductions. And those price reductions are confusing buyers because they think they can wait forever and get this thing to go way down when there's too many other buyers on the sideline, and they see it come down to this level and they say, nope, okay, that's good enough for me. And then you're as a buyer, you're sitting there, well, I didn't know that was going to happen. Well, of course it's going to happen. There's a ton of buyers on the market. It's still a seller's market. And as it gets low enough, as a reduction or two happens, those sellers aren't going to, or those other buyers that you're competing with aren't going to hold still, and they're going to grab that house. So it's an interesting dynamic, interesting market that we're in. But just wanted to come to you with those statistics and just kind of an overall market update. I'm going to do one more thing. I'm going to jump over to the local market data. We're going to run through this really quick and then we'll wrap up. So this is the solds. This is going back to 2019 as well. And what you see is the cyclical market. You got the peaks here in June, July, summer months. And what I want to see here is that our solds aren't drastically below. And actually, if you look at the dip here, it's going up over time. So we're actually selling more houses over time. And this is Indianapolis-based market, 16 metro Indianapolis counties. So this is actually differing than the data I just showed you from the national outlook where the sales were decreasing. Our sales are still increasing here in Indianapolis. We have a great market. We're not hitting any huge slowdown like some of the other major coastal cities and Denver, Dallas type metro cities. They got too frothy and now they're kind of having to pay for it. Indianapolis doesn't go up as high as the high markets, and we don't go as low as the low when there's a bad dip. So we're lucky in that fact. Let's jump over to price. Here we go. Median sold price by month. As again, now you could say, oh, Bo, you said we weren't dipping. Well, look at this. This happened in 2020. This happened in 2021. This is seasonality going into the winter months. Didn't mean to do that. So we're in the winter months from our peak in the summer, and we're going down to winter, and we're going to go back up. But look at the average median line across the board. We're going up in sales. No market crash here. Median closed price per square foot, same story. We got a little bit sharper decline in our winter months here. Instead of it being flat, we're seeing a little decline. You know, I wouldn't sit around if I were a seller or a buyer, because this is just going to peak out again next spring, summer. New listings by month. Again, we need more listings. We're still in a seller's market. This is following the seasonality trend. We're not good. I expect this to start moving back up. The dip is in December here, January, February, and December here. So last 3 years, December, January, February low, and then back up. So we're not abnormal. This is just seasonality right now. Median days on the market. Okay, people are saying, oh, houses are sitting around forever. Well, look at January 19. We're still not back to where those numbers were. So we're still in a more tight seller's market than we were in 19. And if you could go back to 19 and say, how's the market? You would say, it's great. This is best markets we've had. It's ticked up every year from 13 to 19. So in 19 things were great, and we're not even back there yet. But yet the people's gut feelings and people, oh, I can't believe houses are sticking around this long. I mean, this is not long. The average time to sell a home is 6 months over the history. So this is a month right now, right? So this is good. We're still in line with a good, healthy market for real estate. And inventory by month, again, same story. If you look, this isn't even in line with 19. So we do have more inventory. I've always said 5,000 homes seems to be the median. I wish I could go back further in this graph, but 5,000 homes is about a normal market for Indianapolis, in my opinion. And we're still below that. We need more inventory. This still creates a seller's market. Hopefully this information helped you out. And I hope that if you have any questions at all, you can reach out to me here. I hope you like and subscribe our channel for more information like this. But we're always here to help you out with your real estate questions, needs, buying, selling, renting. And we would love to work with you individually, one-on-one. We can do Zoom calls or meet at your home or at a coffee shop. And we'd be happy to help you. We appreciate all of your business and all of your referrals. And until next time, have a good day and happy holidays.